A systemic risk is a possibility that an event in a sector of the economy could trigger a bigger collapse in an entire industry or economy. This risk is generally caused by the companies that are considered too big to fail and make up a significant part of the overall economy. These are also highly interlinked with other companies. The market investors can initially tackle this risk by adjusting their portfolio and moving to other companies and industries. A systematic risk is one that is already present in the economy. It does not impact a single company, but rather a whole sector or economy. This is caused by factors that are not industry-centric, and thus market investors cannot tackle this by diversifying their portfolio. Systemic risks arise from one company, while systematic ones come from bigger economic concerns like recession, high global inflation, geopolitical issues, interest rates, and corporate health. For example, the collapse of Lehman Brothers in 2008 is an example of systemic risk. The company was deeply ingrained in the US economy and generated a major potential risk for the global financial system. On the other hand, the Great Recession in the late 2000s is an example of systematic risk. Its impact was not on a particular company, but on economies across the globe. Another example of this is the fallout from war in Ukraine. In India, the RBI has designated 3 banks, namely the State Bank of India, ICICI Bank and HDFC Bank as domestic systemically important banks. These carry special significance in the Indian economy and have to adhere to additional regulatory requirements and closer supervision. The regulations these banks are subjected to include higher capital requirements in the range of 0.2% to 1%, liquidity surcharges, and tighter large exposure restrictions. In systemic risks, the government, along with the central bank, tries to reduce or minimize the ripple effect from the fall of a company. It may be in the form of regulations and, in many cases, bailouts. The government bails out the company or similar companies to prevent a spillover. For example, after the fall of Lehman Brothers, AIG Insurance was also on the brink of collapse due to its investments in subprime mortgages. The US government did not bail out Lehman Brothers, but it did so for AIG with loans of over $180 million to prevent the contagion. Sometimes the government may also choose not to intervene in the collapse of a company simply because the economy has undergone a major rise and the general markets need a correction. But it carries a high risk as it can destabilize the whole economy and impact consumer sentiment.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.